At certain times you do take a longer view, like at the moment, it's sales to Europe. You know, as the pound reaches 1-to-1 on the euro, I've never seen it. We were getting 160 the euro 4 years ago.
Yep, certainly over 150.
So that's like, blimey, that's like, I can't calculate as a percentage, but that's like a price increase. And plus, all our competitors are largely based in Europe. They've had the reverse. So you'd think you couldn't go 20 years forward at 1-to-1, but that's just too risky. I mean, I remember Jaguar years ago celebrating the finance director having sold forward the dollar at 160 and the dollar was reaching 2, and it sold forward for 5 years and everybody's loading it up. Within 2 months it was down at 130 and the finance director of Jaguar got sacked.
Yeah, in those days for some reason Jaguar were very much a bellwether of the exporting market, and it was sort of common knowledge that certainly once sterling US dollar got to around the 160 level, that became a good level for exporters to try and do a bit more than they would normally do. I think one of the things we've seen in the when we're talking to our clients, certainly over the course of the last 12 months, I think simply because of the volatility that we've seen in the foreign exchange markets, we've just become that much closer to our clients. And simply, you know, when we think sterling euro only 12 months ago was near a sort of 140, 150, and has been down at almost 1. I think, Gordon, you were saying you filled your boots at those levels, and you know, clearly, you know, we try to work with clients to help them manage their foreign exchange risk, but B, I think because of the volatility, the extreme volatility that we've seen in the last 12 months, try and build in a more flexible approach to managing that particular risk. Clearly, when you've got almost parity on sterling euro, it's pretty obvious that, you know, perhaps you should be doing a little bit more than you would in a normal business cycle. But you know, I think this sort of extreme moves that we see in sterling US dollar, for example, this time last year it was over 2. 2 months ago it was down at 135. Yesterday it was up at 166. This morning it's almost back down at 160. You know, that's the sort of extreme volatility. We're trying to work with clients to have a more flexible approach, and rather than just locking in standard straightforward forward contracts, are having more option related structures which A, give you protection, but B, enable you to take advantage of these massive swings.
Well, I think in 12 months' time it'll feel exactly the same as it feels today, frankly. I think at some stage, I suspect we're getting there, we'll tumble down the sort of decline or the recessionary, and we will hit the bottom. And I think as and when we hit the bottom, we'll have, whether it's this W shape or whatever it is, there'll be a number of false dawns that will suggest things are getting better, things will get a bit worse, and we'll just bumble along for maybe 2 or 3 years. But certainly I think our view, certainly our economists will be predicting 0% growth kicking in next year, which won't feel any better than where we are today, because I think all that will say is decline has stopped and we're going to bumble on the bottom.
Well, I share Simon's comments there. I think things will be relatively flat in terms of growth, but however I feel there will be opportunities out there for people in the current market.
I think with the base rates at 0.5%, probably staying where they are for the next 12 months, and the quantitative easing that the government, or rather the B of E, have started pumping in, I'm hopeful that the economy will be picking up very, very quickly this time next year.
There's no meaningful action being taken on personal debt, corporate debt, government debt. I think we'll have inflation kicking in, and cash might not be quite the king it is today, and that will cause it problems of its own. And I just don't see the problems unwinding.
I'm probably not quite as bad as Dan, but what I would say is I think in 12 months' time we hopefully will have reached the bottom, and I think asset values should have stopped falling, and I think people around this table will be seeing some opportunities, and the bank will be prepared to lend you the money to take on those opportunities. So I think 12 months' time I think we'll be seeing a little bit of an upturn in terms of activity.
there will be some change somewhere on the political landscape as well, and that may bring opportunities or not, who knows.
I'd like to think it won't be worse. I know for us, I think the key will be when it does improve, the costs we've taken out, keep them out, and don't let the costs ramp up again because sales have grown. And if we can do that, then we're in for some bumper years when the economy does move, even if it's 1% and 2% growth in our business. That is all just pure profit then.
Those hardest hit sectors will show some revival, some recovery, but generally the economy will be broadly the same because of the level of debt that exists within it.
Well, I really hope there is some improvement. I must admit I don't hold out great hope. I think one of the big unknowns is the fragility of the consumer confidence, and when that starts to improve, lots of the sectors that have been under an enormous amount of pressure, like construction and cars, get the chance to recover.
I'm an optimist. I think it'll be a bit better, hopefully not too much better, so this air of realism that you won't get rich quick with the value of your own house rising doesn't come back too quickly.
There's still a lot of issues out there that haven't really landed yet. There's still a lot of debt out there, and those are the problems that brought on the recession. And until that's fully sorted, then I don't see much chance of recovery, certainly in the next 12 to 18 months.